This is your Lead Left podcast for the week of September 16th. I'm Randy Schwimmer. Welcome back. One of the real joys of our job these days is around Fed meetings. We've known for 4 years that this moment would arrive, but the timing and extent of the rate cut kept analysts guessing. And despite countless experts weighing in until the last minute, the Fed's big move caught many by surprise. Not that the dovish option wasn't on the table. Indeed, until the last day or so, weak labor data pointed to the more dramatic move. But then lower than expected jobless claims shifted opinion back towards 25 basis points. We supported that view, believing anything greater would signal panic. After such deliberate moves for so long, why rush? Which is why these decisions are best left to the experts. Once announced, the move was applauded by analysts and markets. Rather than anxiety about forestalling a recession, it telegraphed confidence that inflation was at last under control and attention could now shift to keeping the economy momentum going and unemployment under control. In his weekly podcast, KBRA's Van Hesser reported a subliminal message from the Fed. Quote, "We are not going to find ourselves behind the curve again," unquote. Historically, he recalled that this was a break from convention, with loosening absent a looming downturn or a crisis situation like the GFC or COVID. Well, regardless of the steeper start to this phase of the rate cycle, the direction is clear. Over the next 15 months, rates will end in roughly a 3.5% range with some kind of pause then. Because we don't face any major crises, that scenario is appealing for the capital markets. Predictability, even within a range, is stimulative. Does this lower for longer outlook mean the end of the golden era for private credit investors? All-in spreads have been at all-time highs, but that high tide lifted a number of boats. Bringing corporate and high-yield bond yields down will increase the relative attractiveness of middle market debt. The easing of financing costs will boost M&A and improve realizations for LPs. Despite grumbling of some worriers, direct lending portfolios are in pretty good shape. Experienced managers have navigated this environment with minimal defaults and losses. Continuous availability of private credit during the Fed liftoff allowed CFOs to right-size their balance sheets and comfortably extend financing maturities. This also bodes well for the economy. Middle market companies provide big shares of growth and employment to U.S. GDP. The challenge is that private equity ownership of the middle market is only a fraction of the total of companies. There needs to be more incentives to invest more broadly in this critical sector. In the meantime, corporate earnings and growth remain solid, and consumers are still spending. As we head into an uncertain election season, at least the technicals point to a good year for credit investors. Reporting from the grumble-free zone at the Lead Left, this is Randy Schwimmer, wishing you and your families a safe and healthy week.